Your next guest has an on-the-ground read on the consumer and the state of spending. He owns properties in California ranging from retail to residential to office and hotels. Rick Caruso is the founder and former CEO of Caruso, is also the chair of the board of USC, Go Trojans, and almost became the mayor of Los Angeles. Rick, I wish we had 100 hours to talk because I got a lot of questions. I was just in Santa Monica. What a disaster that is. But we're going to focus on something else. From your perch as one of the most successful real estate entrepreneurs in America, how are things going?
I actually think, Brian, things are going well, surprisingly well. We went through this period, what was it, Liberation Day, whatever it was called. There was so much unpredictability that everybody was buckling up and holding back. Personally, I'm sort of past that now. I think most of my contemporaries are past that. We needed time and some information and sort of get a cadence of what was coming out of the White House. But the consumer's strong, sales are strong, our attendance continues to grow, sales per square foot is growing, single digit to double digit depending on our properties, retail properties. The resort business has stayed strong for us, so I'm very optimistic that we're going to have a good year.
Sounds like 5% 10-year yields and 7% mortgage rates. I know you're a commercial guy, but commercial real estate is built on borrowing costs in some ways, Rick.
Right.
Sounds like that's not necessarily kneecapping the real estate industry.
It's not, Brian, because, you know, when you look historically, a 5% rate, would I prefer it to be 3? Sure, we all would. But a 5% rate isn't that bad. So what you do is you organize your budget around it. You know, you stress test your pro formas, which we're doing now. We had put all of our projects on hold. We were about to break ground on 3 projects, and then the market was going crazy a few months ago. Now it's settled down. We're green lighting them. We are going to stress test them in case the 10-year is moving a bit more. But if we hang around 4.5 to 5, we're going to organize around it and we'll be fine.
Rick, what's going on with the consumer? Because the data points have been all over the place. How's demand at the shopping centers? What are you seeing?
So there's 3 things that I look at, Kelly. One is sales per square foot, which has stayed strong and growing. The second is attendance on the properties, which we monitor daily through our Placer AI program. And the third and the most important is the attitude and the sentiment of the retailers and their growth plans. And what we're seeing is best-in-class retailers want more space, they want more A locations, and they're growing. And we're trying to accommodate them, both at the luxury sector, but the other sector that's doing really great is the sector that's going after the younger consumer. The younger consumer is spending and engaged, and they want to be in an environment that has a great experience, which obviously that is our forte. And those, you know, the Aritzias of the world, the Sephoras of the world, Alo, Lululemon are doing great.
So things are fine. So the economy's fine, the consumer's fine. The tariff fight, did it matter? Does it matter?
I think it may matter in some circumstances. It may matter in some segments of the market. We're out pricing out projects right now. What's interesting to me in pricing out pretty large construction projects, there's not a great impact of the tariffs. We're buying lumber from the U.S., and so that has helped. Actually, lumber costs have gone down, which is good. And building in this country, unfortunately, is nowhere near as robust as it should be. So contractors are competitive, and we're seeing it being competitive in Southern California here. So I'm pretty happy about that pricing, which is offsetting a little bit the increase of interest costs. But we'll see how that plays out. But right now, little worried about steel, but we'll focus on buying U.S. steel and let the tariffs play out.